Looking to buy, sell, or grow your business to position it for a sale? As the owner and managing partner of Sun Acquisitions, Domenic Rinaldi has personally been involved in over 300 M&A transactions. He has seen and done it all, consulting with large and small businesses across a broad range of industries. On M&A Unplugged, he'll interview buyers, sellers, and their advisors about their experiences scaling, selling, and acquiring businesses. On every episode, you will get key learnings, but most importantly, you will be better prepared for your own acquisition or sale. This is M&A Unplugged with your host, Domenic Rinaldi.
I would like to welcome my guest today, Tad Render, who is a partner with Miller Cooper and leads the firm's Transaction Advisory Services Group. Miller Cooper is a Chicago-based accounting and consulting firm with 335 professional staff serving middle-market businesses and their owners. Tad has over 18 years of experience working with a host of financial and strategic buyers and sellers in a diverse range of industries, including manufacturers, distributors, and service companies. His experience includes buy-side and sell-side, financial and tax due diligence, and general consulting related to mergers and acquisitions. He also serves as the treasurer and chief financial officer of Miller Cooper and its affiliated entities. Our firm has had the opportunity to work with Tad and his team at Miller Cooper, and they are top-notch. Every one of our clients has been more than satisfied with the result of the work that they've done with Miller Cooper. Tad, welcome to today's episode. So glad to have you.
Thank you, Domenic. Excited to be part of the podcast.
So, I'm curious. I'd like to start with, how did you get into the transaction services side? Talk a little bit about your background, and then, how did you get into this part of the business?
Sure. So I started my career with Miller Cooper on the audit side of the practice. At the time, the firm was a fraction of the size that it is today, and you kind of join the audit or tax group. I decided on joining the audit group, worked on a number of middle market, family-owned, closely held businesses, and really enjoyed that. I did get an opportunity to help a partner on several due diligence engagements. Really liked it. The main reason was we were able to add value. When you're part of the audit team, it's a requirement for a lender or for an investor group. Real difficult to add value on the audit side. Very easy to add value on the transaction advisory services side. So started working on more and more engagements, and now run the firm's transaction advisory group and spend 100% of my time on the M&A space.
That's awesome. And look, not to embarrass you, but the opportunity we've had to work together, you and your firm really are top notch. I mean, the work that you've done for our clients has been incredible. And so we've appreciated getting to know you and your firm. I imagine that you've been in a lot of transactions. And like I said in my intro, you represent, you do both buy side and sell side. So I'd like to spend time, talking on both sides of the transaction today. And why don't we start on the sell side? I'm curious, I'm sure there are a ton of things that you could talk about, but, if you were to, sort of bring it down to the, top 2 or 3 things that you see in sell-side transactions, pitfalls or areas where you think sellers could have a better transaction, what in your experience have you seen from the sell side of things?
Well, I think number one, the most important aspect of a company considering going through a sale process is preparing for sale. Ideally, the company is planning an exit even years in advance. But a lot of times the sellers we work with wake up one morning and decide, it's time to sell their business. Or right now with the active M&A market, they may have a friend or a customer or a vendor of theirs who recently sold their business, and they think, well, maybe it's time for me to sell and jump headfirst into the process. So the number one thing is preparing for sale. And there's a lot of aspects that go into that, from a financial reporting perspective to a legal perspective to an operational perspective. So the more a seller can plan ahead, the better the process will be.
So we say this to sellers all the time. In fact, I wrote something the other day related to this because I get asked this question all the time. What's the number one piece of advice that, I offer to people? And I always talk about preparation as being, the number one thing. But let's bring that to life for owners of businesses. What does it mean to them? How can you move the needle? How can their advisors really move the needle when they do preparation? Because I think a lot of owners look at this and say, all right, now these guys, are going to, charge me a lot of money and they're going to work with me a couple of years ahead of time, but is it really going to move the needle? What is the difference? And maybe you can talk to maybe some examples you might even have of clients who did it the right way, who prepared, and you could document for them how you move the needle.
Sure. Number one, it starts with hiring the right advisor. So whether it's the right accountant, the right attorney, the right sell-side advisor, well in advance of going to market. From an accounting perspective, we like to see a company go through reviewed financial statements or even audited financial statements, depending on the size of the business. Typically, smaller businesses have more lenient debt reporting requirements to their lenders. They may not have reviewed or audited financial statements. And that's something that takes time to kind of put in place. So the sooner the better on the accounting side. The other kind of way that a seller can prepare for sale from an accounting perspective is to start quantifying one-time or non-recurring expenses or normalizing certain expenses that are out of market. So for example, officers comp, going out there and getting good comp studies on what a fair market comp structure would be for the executive team, whether the current comp is over or understated. If the company is leasing from owner occupied real estate, going out and getting what fair market rent values would really be, all in the purpose of kind of validating some of these adjustments to historical earnings before a buyer and buyer's advisors come in and ask these hard questions. So and this is just a few examples of some of the things that can be done proactively on the accounting side.
Yeah, it makes total sense. Do you have, not to put you on the spot, and if you don't, that's fine, but do you have any tangible examples of clients where, they came to you 2, 3, 4, 5 years ahead of time and you were able to work on this and you did a snapshot of, what their estimated value might be before you started the work and then after, and could you demonstrate how, it moved the needle for them?
Yeah, absolutely. So one example that comes to mind is an electrical components distributor that we initially started speaking with probably 3 years ago. Luckily, they were a seller who was proactive. They realized there was no succession plan within the business and there would be an eventual exit. When we walked in, their books and records were in shambles. I guess that would be an understatement, and would really not stand up to a buy-side quality of earnings exercise. So the first step was hiring a proper controller. They had been using a family friend bookkeeper for years. We were able to place a full-time experienced controller. And at the end of the day, that comp for a real controller was just slightly more than what they were paying for a glorified bookkeeper.
Wow.
With that controller's help, really cleaned up the books and records and accounting policies. Without doing that, that would have significantly hurt the value. So now with the new controller in place, we went a next step further and identified a lot of these kind of out of market accounting policies they had. They had out of market comp with several people. They had out of market rent, which I mentioned earlier. They weren't taking advantage of vendor discounts that were offered. And when you put your buyer's hat on, and a company goes from break even to $700,000 of adjusted EBITDA, but that $700,000 is completely comprised of adjustments to EBITDA and not historical, factual earnings, the buyer has a little bit of pause. When you look at 100% of the adjusted EBITDA is comprised of adjustments. So we actually worked with them to put these cost savings in place over the next 2 years. So by the time we went to market, the actual reported earnings, had gone from break even to 700 of actual EBITDA. and we kept our adjustments to a minimum.
Wow, that's a great story. That's a great story. And the banks, as we both know, and buyers want to see the earnings, right? All these adjustments cause people pause. And it's not just the buyers. The banks are going to look at that and they're going to have a ton of questions. And even the nature of those adjustments may or may not be accepted by a lending institution. So wow, that's a great example. You mentioned something in the middle of all of that, and some of the people listening may know what this is, and some may not. So I'd like you to just talk about it for a minute. You mentioned quality of earnings. Can you talk about that, and can you talk about the importance of it and the timing of it? Whether sellers should do it before they go to market, because we know often buyers want to do it. But if you can talk a little bit about that, that'd be great.
Sure. So a quality of earnings report, oftentimes referred to as a Q of E report or a Q of E exercise, looks at the company's historical normalized earnings and the ability for that company to continue to generate those earnings on a go-forward basis, which any buyer or lender is going to be interested in. It starts with the company's historical as reported financial statements, and whether those are internally compiled or they have an external firm involved, really doesn't matter, but that's the starting point. And then you adjust those historical earnings based on a number of factors. I've been referring to normalized one-time or non-recurring expenses, making sure those are removed. Another typical adjustment in the Q of E process is making sure that those financial statements are GAAP compliant. When I say GAAP, I'm referring to generally accepted accounting principles. It's kind of the common language of accountants. The more GAAP compliant your financial statements are, the more a buyer or lender is going to understand those statements and have faith in them. So that's another part of the Q of E process. As far as timing goes, earlier the better. On the sell side, we have always been big proponents of doing a sell side Q of E process prior to going to market, because it gives us the ability to uncover issues and develop stories around those issues and potentially fix those issues before a buyer comes in and asks the same question and catches us off guard. So it's a process that's well worth the exercise prior to taking a business to market.
And how much prior? So somebody wants to sell. So here we are in the middle of 19, and let's say somebody, wanted to sell in 2020. When would they ideally have come to you and asked for this Q of E exercise?
So it's a bit of a catch-22, because you want to perform the Q of E work well in advance of going to market, but yet at the same time, you want to present recent financials. So if someone were to plan to go to market in Q1 of 2020, I would recommend starting the sell side Q of E process using a trailing 12-month June 19 period or a trailing 12-month September 19 period.
Right.
When I say trailing 12 months, I'm just referring to the last 12 months of performance. Buyers and lenders always want to see full 12-month reporting periods. Gives them the ability to compare to annual financial results a lot easier.
So 6 to 9 months before you're thinking of taking the business to market is really the right time to do this sell side Q of E. But they should have been working with you a couple of years in advance of that to make sure that everything was in order. So by the time you're doing the Q of E, you've probably addressed most of the issues. Is that correct?
Absolutely. And it's not just us as the accountants. It's also yourself. And I know you and your team are happy to meet with potential sellers years in advance of them actually pulling the trigger, just to develop that rapport, to learn more about the business, to start to vet out some of the operational issues and what are going to be challenges through the sale process. It's the attorneys, to making sure that the company has all their contracts in place. A lot of smaller businesses operate under a lot of handshake deals. So it's important to get the attorney involved years in advance.
Yeah, so to the M&A Unplugged podcast community, Tad is really giving you a tremendous nugget here. If you're a seller and if you're going to sell your business in the next 5 years, you really want to do all the things to prepare your business. Don't wake up one day and say, all right, I'm ready to sell, because you're invariably going to either leave money on the table or not maximize the value of the asset that you have. And just, some forethought and planning and preparation can yield you tremendous upside. So, Tad, before we move over to the buy side, anything else on the sell side? Any other things that you see, or pieces of advice that you would offer to anybody on the sell side listening in?
Well, again, I'll go back to hiring the right advisor and hiring someone who has been through the process before, that can help navigate you through the entire process. And ideally someone who also represents buyers, because it gives you a unique sense of what information the buyer is going to want, what their ask really means, especially if you haven't been through the sale of a business before, and you're working with, let's say, a private equity buyer who's very sophisticated. There are a lot of nuances to the transaction where you can easily get taken advantage of by someone who's more experienced.
Yeah, great point. Great point. Okay, so let's move over now to the buy side and the buy side transactions that you work on. And curious to hear what sort of advice, what are the 1, 2, 3 things that you offer to people who are looking to go out there and acquire a business?
Sure. I'll start with the importance of the quality of earnings exercise and verifying the historical adjusted earnings of the seller. Very similar to the sell side QofE process. On the buy side, we're going to want to vet out all of the adjustments. A lot of times sellers will throw everything under the sun as an adjustment. They'll say, and as a matter of fact, I was just on a phone call earlier today with a buyer who received the seller's adjusted pro forma, and they've eliminated almost the entire SG&A section of the P&L, with the premise that, well, you won't need that going forward because you're already in the business of this happens to be a paper distributor, but you're already in the business of paper distribution, so you're not going to need our rent and our utilities and our sales commissions. And when you dig down, well, all those things will continue on a go-forward basis. So the importance of verifying the seller's add backs is priority number 1.
So in that case, was the seller trying to create what we call accretive value for the buyer, thinking the buyer is going to merge that operation into theirs, and then those expenses just disappear? And what's maybe the faulty thinking around that?
Well, I think the seller's represented in this case by a pretty sophisticated investment bank who's trying to, just like you said, is trying to create value, when in fact, with this specific buyer, the value is just not there. So can't blame the seller for trying, but it's our job to help the buyer kind of vet out these adjustments and what the historical run rate earnings actually are.
So it's interesting. You talked on the sell side about the importance of sellers doing a QofE, and now we're on the buyer side, and you're explaining to the buyers the same exact thing. And I'm assuming that exercise when you're buying a business really needs to be separate from anything that a seller might have done. Is that correct? Or are you in situations sometimes where you'll look at a QofE that a seller has done more to validate their work, or are you undertaking that work separately?
Well, we use a sell side QofE as a starting point, but would look to independently verify any adjustments that were made within that sell side quality.
So when you're representing a buyer in the transaction, if the seller's done a QofE, you'll take that QofE and you'll vet it rather than do your own from the ground up, correct?
Correct. We do use that as a starting point, and it's a great tool. Just like audited financial statements would be a great tool. If on the buy side, if we were to kind of evaluate, 2 different sellers, so same identical business, but we have seller A who has audited financial statements and has a sell-side Q of E delivered to the buyer, and company B has internal financial statements, no independent accountant oversight, weak internal finance team, 9 times out of 10, that buyer is going to go with company A.
So, yeah, I've seen this so many times in so many different transactions. Maybe I'm going to take you out of the accounting world for a second. I'm going to ask you to be a psychologist. What have you seen in the mentality of a buyer when they see that the seller has gone to the extent of doing a sell side Q of E? I've seen it. I'm interested to hear what you see in that buyer when they know that the seller's done that work.
Well, again, I think a sophisticated buyer is going to realize that it's a starting point as opposed to, the end result when they see a sell side Q of E. Now, we do work with a lot of newer buyers, a lot of independent sponsors who are looking to buy their first business, and typically it's a smaller business, who have maybe been in the process of searching for a business for 12 months, 18 months, 24 months, and they may have put the blinders on when it comes to identifying some issues with the selling company. And that's where we kind of step in, and obviously you and your team step in to kind of harness that buyer in a little bit and remind them that they need to be patient in their search, and that, just because they want to get a deal done, it doesn't mean they should get the deal done. They need to get the right deal done. So, and I see those independent sponsors relying on a sell side Q of E, a lot more than maybe they should be.
Than they should, yeah. But it does speak to. I mean, I completely agree. But when a seller is taking the time and expense to go do something like that, assuming they used a top notch firm, it does speak to the seller's motivation, the desire to do a clean transaction. The buyers that we represent, when we bring them into a deal and the seller's done that work, we see them perk up. They get excited. They see somebody who, was willing to spend the money, do the preparation, and they immediately think, okay, this could be, pretty clean business. Now, you still have to verify everything, but they get very excited when they see targets that have done the pre-work.
Absolutely. And to put it in perspective, I would say when that is in place, you see I would say a half to a 1 turn more in valuation, and at least 2 to 3 months off of the transaction cycle.
Wow, that's amazing. So to the M&A Unplugged community, that is massive. When you talk about generating additional value, the thought of just doing some preparation, and then you can get an extra half a turn or turn on the value of your business. And for people who don't understand what a half a turn or a turn is, when you look at your EBITDA, every turn is a multiple. And so when you can generate that sort of increase in value because you just did the preparation, that's significant. So, Ty, why don't we move into diligence? I'm really interested to hear your thoughts on, the diligence process and the pitfalls that you see there, and the advice that you would offer to people once they get into the diligence process.
Sure. So one thing I did want to touch on, we talked about the quality of earnings, and that's kind of the quality of the underlying company's P&L. Another big consideration that we have when we go into diligence, both buy side and sell side, is the quality of the assets and completeness of the liabilities. So often referred to as net working capital elements. So we want to make sure that the historical AR that the company's been reporting is good, valid, clean receivables. That there's no concentration in those receivables. There's no stale, aged, old receivables. There's no outstanding credits hanging out against the receivables. And when we look at inventory, similar concepts. We want to make sure it's good, saleable inventory that's going to turn in the next operating cycle. Not a bunch of aged, old old inventory collecting dust. We want to make sure the inventory is costed appropriately. Is the seller applying gap costing methods? Are they overstating inventory or understating inventory? All of this gets back to the sufficiency and the quality of the net working capital that's in the business, and that's a big part of the quality of earnings process.
Great. So you talk about inventory. I would love to hear a little bit more about that, because that one area in a lot of transactions tends to be a massive stumbling block. I can't tell you how many times I've heard sellers say to me, this inventory never goes obsolete, yet it hasn't moved in 5 years. And so you're asking a buyer to pay for something that hasn't moved in 5 years. And I understand it might be a piece of steel and it's not perishable, but there's that litmus test of, is this really valid inventory? And so you can talk a little bit about inventory and how people should approach that.
Sure. Inventory is an issue on 9 out of 10 deals where inventory is present in the business. It's a number of things. It's obsolete inventory, and you mentioned, sure, it may be steel, but the last thing I want our buyer to do is have kind of permanent capital in the business supporting this inventory that's not moving in the normal course. So there's a lot of ways that you can address this issue. So we just worked on a deal that closed last week where there was some question as to whether or not the inventory, had value and was going to turn. So in that situation, our buyer agreed to pay for the inventory. We had isolated this bucket of inventory that was roughly $500,000, and the buyer said, well, if it's real good inventory and we're actually going to sell it, then we'll buy it from you, the seller, on an as needed basis over the next 12 months, which the seller agreed to. And they came to terms with what value would be assigned to that if and when a customer calls and orders the inventory and we need to fulfill that order. So the inventory will still stay on site and be housed in the buyer's warehouse. Just won't be on our books until we actually need it. So there's a lot of different ways you can kind of bridge the gap, because obviously you have a seller who's saying, this stuff is worth, dollar for dollar, and you have a buyer who may come in and say, maybe 50 cents on the dollar.
Yeah, that's great. That actually is a great solution. There are many others, but that one in particular is a great solution. I'm curious, when you're working with sellers and you're helping them prepare and you get to this inventory issue, like we do when we're working with sellers, how do you help them overcome and realize, what's obsolete and what's not obsolete? Because it's been a very hard thing to get sellers, because they've spent that money, right? They've spent that dollar, it's sitting on their shelf, and they want to get paid for it. And I understand that. Look, I can put myself, and I sympathize with those owners who have all that inventory sitting there, but at the same time, those buyers, they don't want to buy stuff that's just been sitting on the shelf, because like you said, it's tying up capital. So how do you help them overcome that? And are there strategies that you help them deploy so that they're not so long on inventory when it comes time to sell?
Yeah, well, I guess a couple comments. Number one, a seller, it's an emotional process to go through the sale of your business, and they may not always be looking at the hard facts. So what we can help them do is understand in black and white numbers kind of the obsolescence they have in this inventory bucket. And I'll tell you, 9 out of 10 times, a seller isn't even really aware of how old some of this inventory is. If you were to ask them, oh, you isolate this bucket of obsolete, and they say, oh, we've had that for, maybe 2.5 years. Well, we go back and look at purchase records and sales history, that stuff's been on hand for 5 years.
Yeah.
So that happens a lot. So when you kind of really lay it out for them, and then setting expectations. We talked about getting involved ahead of time, having the conversation with the seller in advance and understanding what issues the buyers are going to have with their inventory. Maybe it's liquidating some of this old inventory to make it a non-issue by the time a buyer comes in to look at the business. It's one less, if we can liquidate for 10, 20, 30 cents on the dollar, it eliminates a difficult conversation to have with a potential buyer. So we're always kind of in favor of that, kind of eliminating issues a year or two in advance.
I mean, it's a great point. And when you talk about boosting the confidence of a buyer and their willingness to do a deal, the cleaner the business is when they're looking at it, the higher their confidence level and the more you're going to get paid. If they have to address issues and negotiate things that just, reasonable buyers, are going to expect in a deal, it can bring down the deal, and there's plenty of transactions to be had. So you really need to stand out and have your business stand out if you want to command the highest multiple.
And it's not only convincing a buyer, to get over a certain hurdle, whether it's inventory or any other issue. So we may be successful in that, but then there's typically a lender involved on the buyer side that we also then need to convince to get over this hurdle.
Absolutely.
So a lender is going to come in and do what's called a field exam, where they may come out and physically count the inventory and do the dust check. If there's a lot of dust, it doesn't bode well for the buyer getting financing.
Yeah, absolutely.
And we see that blow up deals often.
Yeah, that's a great point. So I asked you this on the sell side. I want to ask you it on the buy side. Any place or any examples where you've worked on a buy side deal and you were able to move the needle for that client on the value side? Curious if you have any live examples of that.
Yeah, absolutely. So working in a transaction right now, it's a metals processor. We're helping a strategic buyer acquire an existing competitor of theirs that they know well. And we've received some pretty good internal financial statements from the seller, but a couple things stuck out. So one, and not to get too technical, but it shows kind of the value that a good buy-side advisor can add, is that the sellers making an argument that because they pay their payables within the first couple days, that there's not as much working capital required to run the business than what's been reported on the financial statements. So again, their argument is that they could stretch their vendors to normal 30 or 45-day trade terms and still continue to operate the business in the normal course. What that means for the seller is that they're asking for a lower net working capital target. We tend to agree with that position, but one thing we noticed is because the company is paying their vendors within the first 5 to 10 days, they're taking advantage of significant early pay discounts. In this case, it's to the tune of $100,000 a year of prompt payment discounts with their vendors. So we came in and said, well, you can't double dip. You can't ask for the additional working capital because you're going to assume that we're going to extend the payment terms with our vendors and at the same time get credit for, and this happens to be a 5 times multiple, this $100,000 of earnings that you've created by paying your vendors early. So in that case, we're asking for, and I think successfully negotiated, a $500,000 purchase price discount based on a 5 multiple of the $100,000 of prompt payment discounts that won't be there going forward.
Wow, that's outstanding. That's outstanding. Boy, you earned your keep right there.
So when you put that in perspective, that's one of many adjustments we help the buyer identify. And this one was successfully negotiated for, so the kind of return on investment of hiring a good advisor can be astronomical in certain situations.
Yeah, that's tremendous. So, we could probably sit here and talk for hours about all the nuances because, we're only scratching the surface, right? I mean, there are so many nuances and areas in a transaction that you need to pay attention to. And, we could go on, we'd bore people probably, but we could go on. So I think this is a good place to sort of start to wrap. And I'm going to ask you, if you were to put a bow on all of this, what advice would you offer sellers and buyers as it relates to their M&A transactions and what they should be doing?
Number one, preparation, especially on the sell side. Number two, hiring the right professionals across the board. Like I said, that's accountants, attorneys, sell-side advisors, insurance folks, environmental folks. If there's environmental issues, getting the right people involved. And then 3, digging deep. And when I say digging deep, again, that all applies to both buyers and sellers. So a seller should really dig deep into their financials and make sure they're going to stand up to scrutiny and not rely on, a lot of times we hear sellers say, oh yeah, I have an accountant who prepares my tax return every year, so my numbers are good. Well, really dig deep and understand, what's in your financials and make sure it's going to stand up to a buyer's scrutiny. And on the buy side, really digging deep into a seller's financials and not taking the seller's, word for things. So dig deep.
That's great. I really appreciate all of that. And I'm curious. I'm doing a little bit of a straw poll here with folks that have been guests on the podcast. Is there a book, business or non-business, that you've read that's really resonated with you? I'm really curious. I'm trying to collect this information and gather information. And I've actually got 3 books on my list that I'm going to read that I hadn't read before as a result of this. Right
now, I'm reading a book, and the name escapes me, that follows Phil Jackson's, the former Bulls and Lakers coach, that follows his career and how he's applied leadership principles to the teams he's run and how that can be applied to the business world. And it's I've just started it. It's been a great read. Oh, I haven't heard of it. Okay. Well, there's another one on my list. That's great. Tad, thank you so much for being on the podcast today. I really appreciate all the information that you've given. And if folks listening out there wanted to get in touch with you, how can they reach you? Through the Miller Cooper website is easy. My email is trender, RENDER, @millercooper.com. Through LinkedIn are kind of the easiest ways. Great. All right, Tad. Thank you so much for being a guest today. Just to summarize the key points that we heard from Tad, which you're probably going to hear on most episodes. Number 1, preparation. Preparing for your sale or your acquisition is so important. And you heard Tad talk about the fact that he's been able to move the needle for several of his clients just because there was some preparation involved in the transaction. Who doesn't want to walk away with the maximum dollars if you're selling, or if you're on the buy side? Who doesn't want to get the best value possible? So can't emphasize enough the value of preparation. Q of E, quality of earnings. You heard the importance of that, both from a sell side and from a buy side. Miller Cooper, I've seen their work. They're great at it. I really highly recommend both sides that you want to look at doing the quality of earnings. The other pitfall, the other key learning here is the importance of net working capital in every transaction and getting the number right and testing what's in the balance sheets today, the quality of the AR, the quality of the inventory. All those things really matter because you don't want to be left with, as a buyer, you don't want to be left with too little net working capital. And as a seller, you don't want to give away too much, right? And so really understanding what that quality net working capital number is so critical. And then the last one, inventory in particular, you heard Tad mention that 9 out of 10 deals run into some turbulence because inventory wasn't handled ahead of time. Sun Acquisitions, we see this issue all the time. And so if you're a seller of a business, bring somebody in well in advance, have them look at your inventory, clean it up. It's going to make for a better transaction. It'll give you time to go liquidate or do what you need to do with the inventory that's slow moving and stuff that doesn't need to be there. So really, again, appreciated having Tad on today's show. All of today's information will be available in the show notes. If you would like to learn more about the process of acquiring or selling a business, please visit our website at sunacquisitions.com or feel free to reach out to me at drinaldi@sunacquisitions.com. I look forward to seeing you on the next episode of the M&A Unplugged podcast. And until then, please remember that scaling, acquiring, or selling a business takes time, preparation, and the proper knowledge.
Thank you for joining us today on M&A Unplugged. If you enjoyed the show, Please subscribe, rate, and recommend it wherever you get your podcasts. If you want more great information on how to scale, acquire, or sell a business, please visit our website at sunacquisitions.com.